What actually decides an exchange rate? Why one currency is worth a certain amount of another? For most currencies, the answer is the same force that sets many prices, supply and demand. Understanding this reveals what really moves currencies. Currencies are bought and sold in a vast global marketplace called the foreign exchange market, often shortened to FX or Forex. In this market, the exchange rate between two currencies is determined by how much of each is being demanded and supplied. Just as with goods, the price, here the exchange rate, emerges from the balance between buyers and sellers. The basic logic follows. When many people want to buy a particular currency, demand is high. Relative to how much is available, its value tends to rise. It takes more of other currencies to obtain it. When people want to sell or hold less of a currency, demand is low or supply is high. Its value tends to fall. A currency in strong demand strengthens. One in weak demand weakens. Why would people want a particular currency? To buy that country's goods, services, or assets, to invest there, to trade, or because they expect its value to rise. All these create demand for the currency, which must be bought using other currencies. For example, when investors and buyers around the world want more of a certain currency to purchase its country's goods and assets, demand pushes its value up against other currencies. Exchange rate systems and currency rules vary from one country to another, and rates move constantly and can change sharply. Many forces push on a currency at once, and nobody predicts them reliably, so check what applies where you live. The main lesson is simple. For most currencies, exchange rates are set by supply and demand in the foreign exchange market. The more people want a currency relative to how much is available, the higher its value, and vice versa.